If you grew up in the 80s or 90s, when you thought about buying a home, the purpose was somewhere to live. Of course, you cared that it held its value or that it went up a little over time, but first and foremost, it was a shelter. It was where you started your life. But today, when people buy homes, they're thinking very differently. They're thinking about it as an investment, as a way to build wealth, because they know that one bad purchase decision can cost them hundreds of thousands of dollars, and that single shift changed almost everything about the housing market. When homes stopped being just shelter and started being treated like financial assets, prices rose faster, competition intensified, and affordability started disappearing for regular buyers. And none of this happened by accident. It was driven by very specific policy decisions and economic forces that reshaped how housing works. Back in 1960, the average home price was about $11,900, and the average household income was around $5,600. That's roughly a 2-to-1 ratio. Even by 1980, homes were still only about 2 to 2.5 times the average income. In that world, buying a home was very simple. You bought it, you lived in it for decades, you paid it off, and maybe you passed it down to your kids. And homes mostly tracked inflation. They preserved wealth, but they weren't viewed as aggressive wealth-building assets. The primary purpose was shelter and stability. Now fast forward to today. The median home price is roughly $420,000, while the average income is around $75,000. That's more than 5.5 times income. In expensive cities like San Francisco or Los Angeles, that ratio can hit 10 to 15 times income. And here's the real shift. A growing share of buyers aren't just thinking about where they'll live, they're thinking about appreciation, rental income, tax advantages, leverage, and protecting themselves from inflation. Housing stops being just a place to live, and it becomes a financial strategy. You can even see this in behavior. Instead of just asking, is this a good place to live? People will ask, will this appreciate? Can I rent this out? What's the return? Homes are increasingly discussed like financial assets, not just long-term shelter. And one of the biggest policy changes that contributed to the shift in mindset was in 1997 with something called the Taxpayer Relief Act. This was one of the most important laws that quietly supercharged housing as an investment. Before 1997, if you sold a home for profit, you generally paid capital gains taxes just like you would on a stock or any other investment. After 1997, that changed. If you're single, you can exclude up to $250,000 in gains from taxes. And if you're married, it's up to $500,000. As long as you lived in the home for at least 2 out of the last 5 years, that gain can be completely tax-free. Now compare that to stocks. If you sell a stock for a $250,000 gain, you'll likely owe tens of thousands of dollars in capital gains taxes. But if you sell a home for a $250,000 gain under this rule, you can legally owe 0 taxes. And that single change dramatically increased the after-tax return on housing compared to almost any other investment. It also enabled a new strategy. You could buy a home, live in it for a couple years, sell it, and capture a large tax-free gain and repeat the process. For married couples, that could mean hundreds of thousands of dollars in tax-free gains over time, something very few other investments allow. And that incentive pulled a lot more capital into real estate, and it really started to change how people started thinking about housing. At the same time, the financial system itself was changing. In the late 1990s and early 2000s, financial deregulation made it easier for banks to bundle mortgages into securities and sell them to investors. Instead of holding loans themselves on their balance sheets, lenders could originate mortgages and quickly pass much of the risk downstream to investors. And that helped fuel looser lending standards, things like interest-only loans, low documentation loans, and subprime lending. More buyers suddenly qualified for larger loans, which increased demand and pushed prices higher. Homes weren't just places to live anymore. They were becoming tradable financial products. And then came the biggest accelerator, interest rates. After the 2008 financial crisis, the Federal Reserve pushed rates near 0 and kept them there for years. During COVID, they did it again, and this time it included massive stimulus, aggressive bond buying, and extremely cheap mortgages. At one point, 30-year mortgages fell into the 2.5 to 3% range, some of the lowest levels ever in modern history. And that matters because at a 3% mortgage, you could afford roughly 20 to 30% more house for the same monthly payment compared to a 5% rate. All of a sudden, cheap debt dramatically increases purchasing power, especially for investors using leverage. In strong markets, investors could borrow cheaply, they could benefit from home price appreciation, collect rental income, and layer on tax advantages, all using borrowed money. That combination made real estate one of the most attractive leveraged investments available during the low rate era. And if you put all of this together, tax incentives, financialization, and ultra low interest rates, housing stops being just shelter and it becomes a financial asset class. So who's actually buying homes as investments today? There are three main groups. Number one is individual investors, things like mom and pop landlords. These are just regular people buying rental properties, and historically, investors made up a relatively small share of home purchases, generally in the low teens. But during the 2021 to 2022 housing boom, investors surged into the high 20% range in some periods, which was a record high. And during that low interest rate era, investors could borrow cheaply, they could benefit from price appreciation, they could collect rental income, all using cheap dollars. The second group is institutional investors. After the 2008 financial crisis, large investment firms began buying up large pools of foreclosed single-family homes and converting them into rental portfolios. Companies like Invitation Homes, American Homes for Rent, and Progress Residential now collectively own hundreds of thousands of homes, especially concentrated in fast-growing metro areas. These firms treat housing as an asset class. They generate rental income, they package it into securities, and they sell it to institutional investors like pension funds. And when they buy homes, they often have major advantages. They have all-cash offers, faster closing, fewer contingencies, and the ability to outbid smaller buyers. In certain markets, that creates direct competition for first-time buyers who need financing and inspections. They don't have large bundles of cash to just throw at homes they want. And the third group is foreign buyers. International investors have historically purchased tens of billions of dollars of US residential real estate each year, especially in major cities and luxury markets. And that's because US property rights are really strong, and real estate acts as a store of value. It can also hedge currency risk, and in some cases, it connects to residency or visa programs. In cities like Miami, Los Angeles, New York, and parts of the West Coast, foreign capital can meaningfully influence local pricing, even if it represents a small share nationally. And one of the biggest reasons housing is such an attractive investment for so many different groups of people is because of your ability to use leverage. Imagine buying a $500K home in cash. If that home appreciates 5% in a year, you make $25,000. That's a 5% return on your $500,000 investment. Now let's look at the same home using leverage. Instead of paying cash, you put $100K down and borrow $400. If the home still appreciates 5%, the value increases by the same $25,000, but now you only invested $100,000 of your own money. So that's a 25% return on your capital. On top of that, the property can generate rental income. For simplicity, let's say it rents about $2,500 a month or $30K a year. Your mortgage payment might be roughly $1,900 a month or about $23,000 a year. So ignoring expenses just to kind of illustrate the point, that leaves roughly $7,000 in cash flow. So you have about $25,000 in appreciation plus roughly $7,000 in cash flow, and that's a total of $32,000 on a $100K down payment. That's a 32% return in 1 year. And that's how leverage magnifies returns. Now compare that to other assets. Stocks historically average around 8 to 10% over long periods of time, but using leverage in those type of markets is much riskier and limited for most people. And other markets like bonds typically return much less and offer little leverage. Real estate in many markets combines moderate appreciation, rental income, leverage, and significant tax advantages all in one asset. You can deduct mortgage interest, depreciate the property for tax purposes, and in some cases, sell a primary residence with large tax-free gains. That combination made real estate extremely attractive during the low interest rate era. Millions of people discovered variations of the strategy over the past decade, which helps explain why investor participation surged during this housing boom. Another factor that accelerated the shift was the rise of short-term rentals. Platforms like Airbnb made it possible for individual owners to generate higher income in certain markets compared to traditional long-term investing. In tourist-heavy areas like beach towns, ski towns, downtown areas, some properties could earn meaningfully more per year as short-term rentals. Even after higher cleaning costs, management costs, and vacancy costs, that attracted more investors into specific neighborhoods and reduced the supply of long-term rental housing in those markets. The impact isn't the same everywhere, but in cities with heavy tourism and limited housing supply, short-term rentals became a real pricing pressure. You saw the price of homes in those areas jump by a lot. All you have to do is ask anyone that lives in a place like that. And at the same time, psychology amplified everything. Home renovation shows, YouTube channels, and social media made real estate investing look simple and highly profitable. People saw friends and influencers making money on properties, which created a powerful fear of missing out. Buyers began stretching further, waiving inspections, bidding aggressively, and treating home purchases more like financial trades than long-term living decisions. And there are a lot of new consequences with the shift in the housing market. Housing back in the day was anchored to what local residents could realistically afford. Median home prices tended to sit around 2 to 3 times median household income, and the market naturally constrained itself. In this new market, pricing is increasingly influenced by investor return expectations, outside capital, and national or global demand, not just local wages. You can see this clearly in certain fast-growing markets. Take Boise, Idaho, for example. In 2019, the average home price was roughly in the high $200,000 range, while the average income was around $60,000. By 2022, prices had surged well over $500,000, and the price increases were driven by demand by remote workers, migration from higher-cost states, and investor demand. Local incomes simply couldn't keep up. If you were a resident in that area that grew up there your whole life, you would not be able to afford housing. The second consequence shows up across generations. Homeownership rates among younger adults have declined over time, while homeownership among older households has increased. So older generations locked in lower prices and lower rates, and younger buyers face much higher entry costs. That matters because housing is one of the primary ways households build wealth long term. On average, homeowners have dramatically higher net worth than renters, largely because of accumulated home equity. And the third consequence is systemic risk. Real estate now represents a very large share of total household wealth in the economy. When housing prices rise, consumer spending rises, and when housing prices fall, spending contracts, and economic stress spreads quickly, exactly like we saw during the 2008 financial crisis. And instead of reducing the economy's dependence on housing after 2008, policy responses made housing even more central, especially through lower interest rates and renewed investment incentives. That means that the system has become increasingly sensitive to housing prices remaining high. So what does all of this mean for you? It means housing decisions today require more of a financial lens than they did for previous generations. Whether you plan to buy, invest, or continue renting, understanding how leverage, interest rates, and incentives work matter a lot more than they used to. It also means there's still a lot of opportunity in housing, but it looks different than it did when homes were simply places to live for 30 years and pay off. The opportunities now are tied to understanding the math, the risks, and the cycles. You can't just assume that prices will go up forever anywhere you decide to buy. And you don't need to agree with every part of how the system works, but the better you understand it, the better decisions you're able to make inside of it. And that's the point of this video, not to tell you what to do, but to help you understand the system you're operating in, so you can make better financial decisions for your future.